it's something that's like really going to affect the scalability of the company or something like that, then maybe purchasing your own equipment. But for the most part, yeah, leasing assets is usually better than buying them outright at the beginning. Because then you can see if it's useful, and if you get some 6-month lease and it's not useful, and you don't have any specifics, then you just...
But it's kind of like buying two technologies which aren't meant to go together, and that's what we're doing. But we could also buy components of it and produce one thing, and it would be much better than what it is.
It's interesting. I don't know the specifics of it, but it sounds maybe like the second one is sort of creating something new.
Yeah, and that would be where the paper comes in, but that would be a lot more expensive.
Yeah.
So you would then be, at one point, I mean, maybe this would be an angle to, sorry for taking, maybe this would be an angle where you go to the presenter and say, look, I'm looking here for your advice, which route would you take, rather than...
Yeah, that's true. Yeah.
But I'm just not sure if that shows kind of, because before I worked in business development for a long time, a lot of time when I'm saying these are two ways, investors or people have kind of interpreted that as indecision. And they said, well, if you don't know, then that kind of thing.
Yeah, I mean, if you present it like these are the two ways and then have sort of a well-researched path into both ways, I don't think they'd see it as an indecision. They'd see it as well. You know, again, looking for the advice of the investor, these are the two paths we're considering. I think that would be, I don't know, I think it would go. All right. So,
But I think, sorry, on the same point here, isn't it better to actually go do that research first and make up your own mind which is the best way to? Because what are you asking advice about? You could do it either this way, like many products have many different forms they could take depending on what market segment or price capture they're going to. So is it better, because if you're talking about all these different choices, you can go for the cheap version, the medium version, or the really high ground version.
Yeah.
Which one? So if this investor here thinks this version is a really good idea, another investor thinks the other version.
Yeah.
What do you do?
That is true. I mean,
is it better to make the decision yourself?
I would say, actually, especially if you're approaching multiple investors, because then it can become a big kind of cluster F. Like if you give too many choices about it, you obviously have to lead your company, in that way. But that's ask for advice in the beginning when certain things, But I mean, it's like it sounds like an interesting situation. I think actually the way you're putting it, maybe the second way is better because you'd actually be creating something new. So
So these are just statements that look into the future, so they are forecasts.
Projections. So.
But if you are already an operating startup and making already some costs and have some revenue, how would you suggest accounting this?
I would definitely put the actual numbers first, and then you put a nice black bar down, and you have actual, and then you have projections afterwards. So.
Would you suggest using a spreadsheet or some specific accounting software?
I would say to use a spreadsheet because ultimately you're going to want to present these in a relatively, I know it doesn't look so concise, but something that's like, can fit on a couple pages. So if you can fit all your financial statements on one page back and front, that would be really good because the investor is going to not want to have to filter through the accounting printout, the general ledger or something. If they ask for a general ledger, which they very well might, to look at all your transactions, general ledger is just the combination of all the accounting transactions. But it'd be nice if you could give it to them, that's obviously useful stuff to have. But, so I would say just a spreadsheet like this would be very useful.
Yep. So I have a question about projections. How do the investors gauge whether your projections are conservative or exaggerated?
Yeah, well, the market research that you do into it is really important, where you can actually show some numbers. Because if you just make up financial projections, say we'll make 10 million next year, 30 million the next, 70 million, give us some money. That's not going to fly. But if you have some things like we can make this much because the market is this big, and we can penetrate the market and get 15% of the market share because that's what we think we can do. And then to make sensitivity analysis where you say, if it goes really well, this will happen. And if it goes medium well, this will happen. And if it goes badly, then this will happen. And then you have 3 different sets of financial statements or returns to offer the investor. That will look good because they like that. It's like, oh, well, look, they've really thought it through. They've thought of the different cases of things happening.
So they don't necessarily have an understanding of the market
They will want to, definitely, yeah, and they want you to.
But isn't that in the later stage when they do them due diligence?
Yeah, but the due diligence will definitely come, and if your projections aren't already backed up, the numbers you've given them, and then, if you change the numbers a bit because of this, they're going to say, why is this number different now? And, and this is things that are alarm bells to them. I mean, they do know that the financial projections are not going to be spot on, they know it's not going to be like a science.
But that's the thing, how do they know whether it's really a conservative number or?
Yeah, they'll, have someone like me that they've hired who's going to be looking through it and then looking at all the market data and saying, like, this and this and this.
I'd like to ask something.
Yeah.
Is there any companies that does research before you get started running? I mean, like Worthwhile, are there others?
That's a good question, actually. I don't know off the top of my head. I mean, we were doing the market research ourselves.
I've been recommended Worthwhile, but I don't know this company. I would like to ask any one of you in the room if you have got anything to do with them or had anything to do with them, if you could recommend them.
Really cool.
They are called Worthwhile.
Worthwhile.
Yeah.
I know the British Library's got a business section for these courses.
What are they called?
The British Library.
British Library.
Yeah.
Okay.
Business section.
Yeah.
Resources.
Okay.
Okay, actually, I'll look into it. So if you want to send an email afterwards, I'll look into it and see. Cool. Yeah. Okay.
Final question, as a rule of thumb, is it better to be, if you project it, is it better to be conservative, optimistic, or?
I would say that erring on the side of conservative, or it's even better having like the sensitivity analysis where you have a really good case, a regular case, and then a bad case. Then they'll show you thought of sort of, you can make any number of them, but 3 is a pretty good number to have good, medium, bad. And then you can say, this is a really optimistic one, this is, what we think is going to happen, and this is if things don't go as planned. And that's good because then you can say, you always make the sort of cash that you want to be somewhere in the bad area because you think, wow, if everything goes to, really badly, we can then, still survive for 5 years until we get the revenue we need, et cetera, et cetera.
Sorry, just
Yes?
maybe I missed them at the beginning. You're showing us what to show to the investors, but what's actually before? I mean, how do you select your investors? I know that there are different rounds, so you might not, for example, approach the venture capitalists at the beginning. So how do you know exactly what kind of investors to go to according to the stage? And then the second question is, how do you evaluate the share that actually the investment's worth it?
Okay, we are coming up to the share structure in seconds, but to answer your question about which to be approaching, basically if you have just an idea, you want to go with family and friends because even angel investors are going to be a little bit troubled by that. So their angel investors are at the point where maybe you have some money, maybe not, it's not like super important, but you've got some serious contracts in place, you've got a variety of market research into it at least, and hopefully you started operating a bit, or you really are close to operating, but you just need cash to get things going. Then the angel investor is going to consider it. So they're going to think, we've got these contracts with the clients, like it's like $1 million contract, just needs to put in some money to get it started, and then the angel investors are going to be interested. Venture capitalists is really if you're operating already, so like for example, there's a place called Zen, which is an Asian fast food restaurant. They got a bunch of money put into it by venture capitalists, and they had like 4 or 5 restaurants at that point. And I personally think they ruined the restaurant because they completely, they cut all the costs and made the food terrible. But so at that point, like 3, 4, 5 restaurants. You really are making some money already, then the venture capitalists come in and that's when they go. And from beyond, I mean, it doesn't really matter for the sake of this conversation, but then you've got private equity guys, that's when they come in, and then afterwards it's the leveraged buyout guys come in way at the end of the cycle of the business. So, but that's way down the road.
Sorry?
Yeah.
For you, what are the main differences of dealing with the business angel compared to venture capital and compared to a corporate venture?
Like what's the main differences between?
In terms of dealing with them, in terms of their expectations, overall, in a
Yeah.
nutshell.
Yeah, the venture I mean, it's more institutional at the level of venture capitalist. So the venture capitalists, they really are going to expect you to sort of dot all your I's and, you know, it's like you present to them, you sit down in their office and they look it over and they tell you this, that, and the other thing. And it's really, there's a process to it, it's institutionalized at that point. The angel investor could be a little bit more informal or more formal depending on, you know, which one. But usually it's just a very wealthy individual who's interested in, you know, sort of helping these early stage businesses. I say helping, but obviously they're getting a chunk of it, you know, but investing in these early stage businesses. And so, yeah, and so that's the really big difference.
And in terms of corporate ventures, so like for example, Google Ventures or Intel Capital.
Yeah, and an incubator.
Yeah.
I would say that's more like an angel investor, definitely. So the incubation stage. Everyone knows what an incubator is. This is really interesting if you have a tech company. They take care of a lot of your expenses in the beginning with the expectation that you get share, or you know, that they get shares, but sometimes they hook you up with the right programmers or the right people, you know, in the incubator itself. So incubators are pretty interesting for some of you guys, I'm sure. Yeah. Okay. Next one. Breakfast. Good. All right.